And we are going to be able to share it with Positively Natural with Renee and with Marcy at Maho to be able to put on our websites for you to view later. Saying that, I want to just give a real quick, brief description of our panelists. Now I'm going to have to look down to read, so forgive me. AEGIS, is that correct how I say that?
Yeah, that's right.
It's an entrepreneur law firm with a heavy focus in small to mid-sized businesses. Rochelle, Ms. Walk, has a significant experience in representing consumer products, companies, and retailers, including retailers that sell through e-commerce. She served as our outside counsel for many, many years. Thank you, Rochelle. Scott Levine has been an entrepreneur and works with businesses as well as venture funds. He's an active member of Entrepreneurs Organization in St. Louis and nationally. We will have someone that will be joining us in just a little bit. Her name is Susan Nieland. She's a CPA at CFO Solutions in Tampa. She works with growth and finance advisors and small business owners and entrepreneurs. Susan believes in small businesses so much that she's devoted a substantial amount of her time volunteering with organizations that assist small business owners, and we thank you all for being there. Rochelle, I'm going to ask you to begin our webinar with the latest information you have about the CARE Act that impacts small business.
That's great. It looks like Susan is trying to get on. It may be that you have to do something to put her on, because it looks like she's in the chat but is not showing up in video.
We're getting that.
Okay, terrific. Thank you. Okay, well, first of all, thank you all for having us. My partner Scott and I are delighted to be with you today and to do our best to answer questions. And honestly, I'm just going to say this: by the time we finish this webinar today, many of the answers we give you will be wrong. The law, the rules are literally evolving and changing as we speak. And because of that, we're in a situation where, they talk about unprecedented times. I mean, clearly this is an unprecedented time, but even the work that we're doing is at best confusing. We received a lot of questions. It says your speaker is not working. Please check your connection. Are you not able to hear me?
We can hear you fine, Shelley.
Oh, okay. I'm just getting something that's saying the speaker's not working, and I didn't know why I was getting that notice. So I think that, as we go through this today, and frankly, our goal today is, oh, there's Susan. Our goal today is to try to answer as many of your questions and give you a little briefing of what's going on. We realize, though, that the rules are changing, and I want all of you to realize that the rules are changing and evolving by the minute. I'll give you a great example. I was on the phone with the lead SBA lender at Valley Bank at 12:58 Eastern time today. At 1 o'clock was their first training through the Insured Banking Organization. So the federal banking organization was going to have this for all federally insured banks seminar that started today at 1 o'clock. And as he and I were talking and going over the different ideas and the different thoughts about how different loans are going to work and trying to answer some of the very specific questions, not that just you had, that others of our clients had, his answer to me was, I think this is the answer right now. I'll let you know in 90 minutes when training is over. And I am fortunate to have the kind of relationships I do have with SBA lenders where they are willing to talk to me and call me. And like, he literally called me back within about 5 minutes of when I made that phone call. And so I felt very privileged at that moment, because these guys are just slammed. So thank you in advance for your patience with us. There's a couple of things that we're going to talk about today and put them in categories. I think the hot topic for the day is, do I qualify for, and how do I qualify for, the Payroll Protection Program loan, PPP? Some people are interested in the EIDL loan, which is the emergency loans that are available for revenue loss. I think today we're going to spend most of our time focusing on the payroll protection loan, because those are hot for today, and the EIDL loans frankly, we can deal with in the next coming weeks once the PPP loans are addressed. Plus, I think for small businesses, most are going to fit into the category of idle loans, although some of you will likely fit into or want, I'm sorry, will fit into the category of the PPP loans. Some of you will want idle loans in addition. The other topic that we can try to answer, and Scott and I are both well aware of what's going on with the unemployment and the various questions that come up regarding the paid sick leave as well as emergency FMLA. But I will be honest with you, again, regulations are due out in April. They are trickling. Today is April 3rd. We are all prepared for whatever is said today to be absolutely wrong by sometime next week or the week after, or whenever the government gets to finalizing regulation. Going back to the CARES Act and the Payroll Protection Program, the regulations in interim final form, as they have been named, came out last night at 8:30. So we are navigating and have already found loopholes in language and words that make no sense. We're working on it. With that, I'm going to start by just sort of giving you a high overview of what the PPP loan is and what it is not. There's a number of questions about that. If I don't answer your specific question, circle back and come on the chat or raise your hand through the question and answer. I think if you look on your screen, there's a Q&A provision, and feel free to ask us a specific question and we'll try and come back to it. But in general, here's what these loans are. They are payroll protection loans. What that means is that our government has come to the conclusion that a lot of people are going to be laid off. We know that there has been extra money, up to $600 a week, extra that people can get if they apply for unemployment. But these are actually loans that are designed to bring people back to work. So if you normally have 5 employees and maybe you've laid off a few, the goal would be to bring those employees back to work during the 8-week period that follows getting the loan, getting yourself back up to the same number of employees you had a year ago. So they're going to look at your trailing 12 months and they're going to look at headcount from the headcount you had for the same period a year ago. If you are a newer store and you weren't in business a year ago, your period of time that you would look at would be January 1st through February 15th or February 29th, I think, is the period that they're looking at. So you're not out of it just because you didn't have a store last year, you didn't have payroll last year. And they're going to be looking at your 941. Clarification came out last night. Yes, independent contractors can apply for these loans, but you may not apply even if you're hiring independent contractors. You can apply for the loan for your employees if you hire independent contractors, but the independent contractors themselves will have to apply for themselves in this loan. So what is the loan? It is 250% or 2.5 times the average monthly payroll for your payroll. And again, they're going to look at your 941. Your 941 is that form you file with the IRS every quarter is the 941, and then the 940 is annually. And they're going to look at your 941s and they're going to use that as your support for why you have payroll. And then they are going to take your average monthly payroll and you calculate it. So it can include your benefits. It includes your, if you have commissions, if you have any kinds of money spent on employees directly for employees, pretty much is going to be included as benefits, but not like if you have a tuition program where you reimburse tuition, that is not included, but it's pretty specific as to what is included. And you can take that average monthly payroll, multiply it by 2.5 times, apply for the loan, and then when you get the loan, if you're back and get yourself back up to your normal head count, and you get the payroll dollar amount to be within 75% of what your similar period was during the 8-week period after you get the loan can be forgiven. If the loan isn't 100%, let's say you only do 50% of the payroll, it will forgive the loan, but it'll only forgive a portion of the loan. I'm going very fast. This is the high level. We're going to get Susan and Scott on the details, but the high level of this is, so it's really a grant to the extent of forgiveness, and then the difference is a loan. And what we now know as of last night is that the loan will be, to the extent it is not forgiven, it will be a 2-year loan. Your first payment will be due after 6 months, and the interest rate will be 1%. So this is really low cost money. Again, in order for it to be forgiven, you bring your people back to work. There's lots of nuances to all of this, and there's lots of questions, but the whole concept behind it is to get people back to work. It isn't a loan to cover your revenue loss. It is a loan to help you have a good reason to bring people back to work. The idle loans are designed for revenue loss and other kinds of business interruption. And we can talk about that, and we can talk about insurance if you have questions about things like that. But I'm going to focus right now on these PPP loans. So with that, I am going to open up. I have a few different questions that people have asked. And I thought I would start off with Susan, who is PA and is helping do these calculations. And Susan, what are you seeing? You're probably going to have to unmute yourself.
Rochelle, can I
Yes.
stop you? Can I stop you for just a second? It's really getting distorted on your end. I don't know if everyone's having that.
I can try and call back in with a phone line if that'll work. Do you think that would be better?
Shelley, in the meantime, I can share a few things from the street.
Okay.
So a lot of people are rushing to do this out of a concern that this is a first come, first serve, and there's a limit. As a practical matter, what's happening is the banks are lending their own cash. And so they're not lending money in the context of what's available to them from the government or what they expect, or some fraction of what they expect to be reimbursed. The banks are assuming that there's enough money in this program to cover 8 weeks of payroll under $100,000 for everyone who works for a company that's 500 employees or less. So while there's, the money is not coming from the government to you, the money's coming from your bank to you. So that's one point I think we should make. And there seems to be a rush right now because a lot of people feel like this is too good to be true because this has been such a catastrophic, economic moment for everyone. But that's the intention is to quickly move money to people who were working for you, and so that you bring them back. The other thing, the other point I wanted to make, while you can go to any bank in theory, these banks are lending you money. And so banks lend money first to people that they do business with already. From an underwriting standpoint, they want to work with, they're taking care of their customers first. So while some of the larger banks may be built to scale and have an application process that's efficient because, US Bank has 2 million business customers. If you have a relationship with an existing bank, one, you might want to check with their ability to fund the volume of loans that they anticipate. We were just talking to our banker, and who's in their bank is in a good cash position, but the money has to come from the bank. The bank has to have the money to do it. And so it's not, wouldn't be inappropriate to talk to your bank about their ability to fund, because you can't get money from more than one source. And so further to my first point, the banks do not anticipate that this program will run out of money. Even though currently it's $385 billion has been earmarked for this. That's based on basically what employers under $500,000, if they were to weeks capping it at $100,000 per employee, how much that would cost. So they're anticipating everyone will take advantage of this. And if it needs to be increased, the unofficial word on the street is that there's enough money for everyone. And frankly, not everyone meets the standard. As Shelley mentioned, every business is going to have to certify under criminal penalty certain things about their business. And if you're not able to meet the terms of those certifications, then that means that your current status is one thing, and maybe a month from now it's a different status. So that's why you have until, I don't have it in front of me, sometime in June to apply for this money. So those are my sort of preliminary thoughts. We're fielding a lot of questions from panicked clients, et cetera. The other thing I would also say, even though everyone's sort of rushing to get these in, and it probably means that most people will have them in today because it's a very short application, and the kind of information you need to support the application is stuff that you would have at your fingertips if you're, if you have payroll. I would, you can engage an accountant, you can engage an attorney to help you, and that attorney can get paid out of the bank's fee. So if you need help, contact a CPA, maybe an attorney. And we, frankly, I don't think there's a lot of work here for professionals getting these applications in, unless your house is not in order and you need help, which is something a CPA could typically do. But just know that not having money to pay a professional to help you is not intended to be a barrier, and that they have specifically provided a mechanism for you to engage an attorney or a CPA, among other professionals, and they get paid 1% of the loan proceeds. Banks are getting paid somewhere between, I think, 2 and 5%, depending on the size of the loan.
Hey, thanks, Scott. That's all really great information, and hopefully everyone can hear me better. Oh, it says I am.
Right.
Okay. And so I'm going to try and attack some of the questions that we see coming up. And with that, Scott is right in that there is this mad rush to the finish line. I know the bankers that I've talked to have said that they have told their families that they're going to be out of commission 90 days handling these kinds of loans. So the question that first comes up on the list of questions that you guys have asked is, how do I take advantage of the loan? What I am hearing, and I'd love to know what Scott and Susan are hearing, but what I am hearing is that the banks are prioritizing their clients first. What that means is you need to reach out to your bank. You need to go to your bank, and whether it is your depository bank or it is your lending bank, but you need to be a customer of that bank, and then you need to reach out to your banker and say, I'd like to be included in this. And that bank will be your source for this loan. Now, if you don't have a banking relationship, or if your bank is not an SBA lender and the SBA is authorizing additional banks to do these loans, it is possible that you might go to a different bank. But most banks are not opening up to non-clients yet, to Scott's point.
I'm going to comment on that. Yes, that's true. And going back to my point about how much cash banks have, not every bank has the same level of liquidity. So at least 2 banks that I've spoken to are telling their bankers to use this as a lead generator to find new clients. Not every bank's going to be in that position, and whatever community you're in, your lawyers, your accountants, even your bankers will know who's in that category versus who's just trying to take care of their own clients.
Right. Susan, what are you seeing on this?
Very similar. I've got banks that are saying they're only going to take clients that are current, customers that are current clients of theirs. I've got another bank that I'm working with that's very willing and able and happy to open up an account and start a relationship if somebody wants to come and, you know, do a PPP loan through them. I've also been in contact with another bank here in Tampa that has said they'll take people that are not current clients, but they're going to prioritize current clients first. So, you know, that's just something to kind of keep in mind from the banking perspective. I agree with Rochelle that, you know, if somebody's got a current bank relationship with an SBA lender, is get with the loan officer, the SBA lender, and their list.
And so, Susan, you said something else that I thought was very smart, and another client of mine mentioned this earlier today. They're having a hard time working with their bank. They were advised to open an account at another bank. And the bank that said, if you open an account, we will put you on our list as a current client, which I thought was just fascinating. Now, I'm not suggesting that people go run out and open up new bank accounts. I do have one bank here in Tampa that told me that they are interested in non-client opportunities to participate in these loans. And so I've told a few of my clients that I can connect them in that regard. But it is an interesting time. Okay, another thing that they're asking, and Susan, I think this is really a question for you. What do I need to prepare, and what documents do I need in place? How do I do the calculation so that I'm ready to prepare my application?
Absolutely. So you mentioned it ahead of time. The 941 is key. So what I've been doing and what I've advised my clients to do is take their 941s and calculate the average payroll amount starting with the 941s, because that's what the bank is going to be looking at when they're verifying the number that you're giving them as your average payroll. And then from there, state and local taxes, payroll taxes are also included. So if you want to include your, quarterly state unemployment tax filings as well, they're not as significant. And then any support that you have for any employee benefits, medical, dental benefits that you're applying. So basically anything that you can put together to support the number that you're coming up with as your average payroll amount. But start with the 941s. I would definitely advise.
Okay, and one of the questions is what other, besides the payroll, what else will be needed? And I think, Scott, you mentioned this. There's an application, and the application is like a 2-page application from what we've seen, but it does have a certification. And Scott, I don't know if you want to talk a little bit about that certification. There's clearly there are some rules and some words that they're looking for in the certification. Scott, is that something you have in front of you, or do you want me to?
I do have it. Here's the key. There's two provisions that you'll have to sign off on. One of them says that current economic uncertainty may request necessary to support the ongoing operations of the applicant. Unlike other, provisions in loan agreements and loan applications that we've seen for decades and understand how they're interpreted, we don't know exactly how this is going to be interpreted, but this is an underwriting question, and it's a pretty simple check the box for your banker. Second, you're certifying that the information you're providing is accurate. All the supporting documentation is accurate, and this is there's an associated criminal penalty for not doing it. I'm not sure if negligently is one thing, but intentionally obviously is another. So those are the key certifications, and you're acknowledging that you understand how the forgiveness portion works and what you're entitled to use the money for if you want it to be forgiven. And they're not complicated. You'll read it and you'll see it. You have to just certify that those things are accurate. And your banker, their process is this is a loan the bank is issuing. So their underwriters are reviewing what you send them, looking at the payroll information to make sure there's alignment with what they understand your payroll is, and what they understand about your business. You know, if you're asking for last year's payroll and you're already out of business and don't intend to open up again, well, they know that you're not going to be able to repay the money, and you know, there's a portion of this that they're going to be responsible for as a bank that the government's not going to guarantee. So there is a little bit of underwriting happening with your bank, albeit, you know, much different than a typical borrower scenario. But yeah.
Yeah, it's an interesting dilemma with the banks because it's 100% guaranteed and there's theoretically 100% forgiveness. But the banks are responsible for their poor underwriting choices. So if they fail to do their due diligence, or if they let your math come through and then later when they come back to audit and they have not been compliant with this program, it is the bank still making the loan, and it is ultimately the bank's responsibility. One of the questions that came through is, how much can you borrow? And the rule is up to, any individual borrower could be up to 10 million. But you would need to have a very significant payroll to be borrowing 10 million. And, you know, and this is clearly, you know, most of these loans are clearly going to be much less than that. But the maximum amount is 10 million. Another question that was raised is, are owners that are on payroll eligible? And there's been a few other questions about S-corps in particular. So, you know, I know Scott and I have been looking at this, and Susan, I think you've been looking at this. My view is that if you are an S-corp and you're the owner and you are actually getting payroll, then your payroll will count. There is a maximum of up to $100,000 on any one employee. So as long as your payroll is under 100,000, or to the extent it's over 100,000, you cap it at 100,000 for you as an individual. Yes, you as an owner can count. The bigger question is what happens to your draw, or what happens if it's an LLC and it's not an S-corp and you have been paying under a self-employment tax scenario. You know, Susan and Scott, do you have any thoughts about that? I can't hear you. He's shaking his head.
I'm going to defer to the CPA on that one, because that's a nuance that I haven't been able to get a straight answer from the bankers from.
Susan, any thoughts?
I will say, you know, with everything that's the moving parts, that's a tough one, because if they're going to be looking at the 941s, they're going to go based on the salary that's going through payroll. So I would definitely open up the conversation with the banker and explain how you're calculating your average payroll and why you're calculating it that way. So that
well, and also note that in about 10 days, right, this program up to independent contractors and everyone else. So if you're not getting in this round, that doesn't mean you're out. It just means that they want to separate the independent contractors and sole proprietors this first wave of debt.
Yeah, I mean, it seems like there was clearly an intention to cover payroll and independent contractors, and I think it's April 10th that they said they're going to open it up to independent contractors. And we'll see if they make that date, because that's actually next Friday. But I think Scott's right. I think that is your opportunity. If you haven't been taking payroll, or if you're one of those owners who's been taking a very low payroll and a much bigger draw, you will have some disconnect, and I think you're going to have to decide and talk to your banker whether or not that draw is really self-employment, because my sense is that if you're not paying self-employment tax on it and you're an S-corp, they're going to look at only that portion which you are taking and is subject to employment taxes. If you're an LLC and you've been paying self-employment taxes, they are likely going to be able to see that you've been paying self-employment tax, and they're likely to be able to work with you on that. I think at the end of the day, these banks, from what I am hearing, need to see documentation that justifies the payroll nature of the distribution.
There's a question that's been coming up quite a bit, and that is, what if I have cash in the bank? Is that a barrier to getting this loan? If I have $500,000 in the bank, the short answer is it's not a barrier in and of itself. They're not doing an analysis of your cash flow, your assets, your liabilities, but does call into question, if you have that kind of cash, whether you qualify and can make the certification asking for. It really is, relative to your entire operation. If that's 8 months of payroll, then arguably it's going to be tough to certify in good faith. But that's really between you and your banker and criminal counsel.
Yeah, and I know that there's another question that came up from an attendee about what happens if you have a NAICS code that isn't listed, or the drop-down menu for the business type you're in is excluded. And this isn't. You're going to have to talk directly to your banker, which is part of the reason I say you need to get with your bankers. I don't think that there is a general intent to exclude retail, but there are clearly business excluded, and that it may be somewhat of a bank by bank decision, and it may be fact specific as to what you do in your business. I'm going to try and look at this while we're talking and see if I can find anything specific in the new rules that limit the nature of the business, but I have not seen that in terms of a health food store or grocery store not being eligible. But we can certainly look at types of stores and see if there is an issue with them. It may be your bank, though, and that's one thing I want everyone to keep in mind. Bank by bank, bank is lending their own money. The banks have some authority to make some decisions about who they will and won't lend to, although in general, the SBA lending rules have been relaxed substantially. So we'll keep looking for that. I see that that's a question that has come up. And Deborah, feel free to jump in and join the conversation with questions that you're seeing. I know it's sometimes a little hard on panels like this to watch questions and chat and talk. So
yeah,
so
here's
please.
one. Can I just kind of, here's one that came in. It says, do we qualify if we only have one employee and that employee is still working but hasn't been laid off?
Yeah, from my perspective, this loan has nothing to do with layoffs. Actually, it is all about keeping people working. So you do qualify, and if your payroll for the 8-week period after you get the loan is you had one employee during the relevant period in 2019, and you have one employee at the end of the 8-week payroll period, then you're good. You never had to have laid someone off. As a matter of fact, if you lay people off, you're expected to bring them back because you have to get your payroll dollars and numbers back up. So the fact that you've had no layoffs, and I'll use our firm as an example, Scott, we haven't had any layoffs yet. As a law firm, we're going to apply for this loan because we certainly, we are certainly experiencing some differential. I'll tell you one of the biggest differences that I've experienced is I'm doing a lot more time giving lectures and catching people up on how this law works that'll probably never be chargeable work. So the firm's going to see a dip, at least in Shelley and Scott and in a few of our other attorneys that are heavily involved in this. But at the same time, it's the right thing for us to do as a firm. So we didn't have a layoff, but we are going to apply for a loan, and there's no reason you have to have a layoff to apply.
I have
And
one.
I'd like Susan and.
I'm sorry. I was going to tell you.
No, go ahead.
Okay, I have one other. I know you guys are touching specifically on the Paycheck Protection Program, but there is. I was on the phone with a retailer this morning, and the state of Florida has been hit, and that's where we are, and that's where our offices are based out of. But the state of Florida has been hit. A lot of our independent retailers, they generate their income from a lot of what they call the snowbirds that come down. That's where their income is. That's where they get all of the revenue to make it through the summer months when everybody wants to go home because it's really hot down here. But one of the things is a balance. So with these retailers who are wanting to do this payroll protection plan, some of them are trying to determine, is this the right way to go? Is this 2-month salary type thing? And then once we do it at that point, is that going to carry us through the summer months? Or is the EIDL something that might be a little bit better for them to look at and to make that a little bit more appealing to their business for the long term?
So I think you can do both, and Scott, I know you may have some thoughts on this as well. I see you're still on mute though. You can do both. You cannot use the money for the same things in both. So in other words, if you do a payroll protection program loan, when you apply for EIDL, you cannot use the same payroll expenses as the reason for the EIDL loan. If you have an EIDL loan, you are able to roll it into the payroll protection loan, should that be the right decision for you if you did use payroll as a reason, which would now make it forgivable. Remember, EIDL is not forgivable, yet if you have the payroll protection, it is. Payroll protection may be more limited than what you need if you've had a real disaster and you need recovery. I don't know, Scott, do you have some additional thoughts about which loan and how to work them together?
No, everyone that I'm talking to who needs more than the payroll and really needs the disaster loans are applying for both, and you can they're going to be integrated in a meaningful way so that you don't have to make that choice. Because obviously, if you have suppliers and a lot of overhead that's not included in the PPP program, then that's not a solution for you. And this is the quickest way of getting cash. So they're encouraging people to pursue both paths if they're needed.
The one question that's been asked is, on this PPP, let's just call it that. It's a lot of talking here. What is the amount of interest that is going to be if you have to pay it back, or what is the amount of interest on that particular loan?
So the law itself, when passed, said up to 10 years and no more than 4% of interest. And then earlier this week, forms came out and said the payback would be 2 years and 0.5% of interest. And then last night's rules, it came out and said 2 years and 1% interest. I think there's actually some leeway in the banks and what they actually do. But the most recent thing that I saw from last night was that it was going to be 1% interest and up to 2 years to pay it back. Now, keep in mind, there's no prepayment penalty, and the first payment's due at 6 months, but interest is accruing. So let's just, make it really simple. Let's say your loan turns out to be $100,000, and you have 1% interest. So that's $1,000 for year one, $1,000 for year two. It turns out that you do not get 75% of your payroll dollars back, or you don't get your payroll head count back in time, and let's say only 50% of the loan is forgiven. Now you have a $50,000 loan, 1% interest. You can pay it back at any time you want. You could choose, let's say you didn't use the money, you could choose to immediately pay it back, or you can use it as a low interest loan over payable, you pay it back over that 2-year period. So there is some leeway here as to when you pay it back. And again, it's very cheap money, even if it were, and we don't think it'll be at 4%. We think, as of last night, it was 1%. As of last Monday, it was 0.5%. I guess it will be between you and your bank as to what it really settles in at.
Yeah, the rationale, moving it from 10 years to 2 years was a lot of people's eyes just lit up saying, well, I can replace my more expensive 7-year note with, a very inexpensive 10-year note. So they don't want people making that choice if they are in a position to have that choice.
This may be for Susan, a question here. If I borrow now and my business does not suffer until 60 to 90 days from now, and I intend to use the loan during, and I'm assuming what this person is asking, it's the PPP loan. If I intend to use the loan during that slow season to keep people employed, is this a possible way to have the loan forgiven?
They're actually looking at the 8 weeks subsequent to getting the loan. So if your slow period is during that 8 weeks, that would apply. But if it's after that, they're looking at how you're spending the money the 8 weeks after you get the loan. So that's where the forgiveness comes in. Rochelle, do you have any other ideas?
Yeah, there's another piece to this, and that is there is some language in here for seasonal businesses. And for some of our members at SENPA, and I think I saw Marcy Kraft on, I do a little work for the Midwest region as well. And for some of you, you have a seasonal business, albeit maybe 2 different seasons, Florida being slow in the summer, and perhaps the Ohio and Midwest region being kind of more active in the summer. There is this concept that if you are seasonal and this period hits you at a seasonal time, the look back period would be the season last year. So if your loan came on May 31st and you're here in Florida, your relevant period would be the similar period from last year. Again, this is the stuff you need to talk to your banker about, because in theory, your average 12 months is whatever your trailing 12 months is at the time you apply. But if you're a seasonal business, and my example is, let's say you're a summer camp, let's say you're a health food store that is on is here in Florida over the summer. There is language to say if you're a seasonal business that you would be, your look back period would be to the same season.
Do we have any more
If Scott or Susan are seeing anything else on that. And Scott, I think you said to all panelists on your note there, I think you need to say to all attendees. We're Scott and I and Susan, let me know if this is okay with you as well. If we provide your email address if people have questions afterwards, or would you like them to come through us and if they need a CPA, we'll sort through?
That's fine with me. Absolutely. Happy to help.
Okay. All right.
Scott, are you okay with that?
Cool.
Oh.
Yeah, Scott's fine.
Okay. We will definitely do that. So our attendees, is there any other questions that we need? We have just a couple more minutes and then probably we will sign off. And just so you know, we will have this recorded, and as I said before, it will be on SENPA website, and it will also be available. I'm going to be sharing that with our alliances with Positively Natural with Renee, and with MAHA with Marcy, so that they'll have it available for their membership and the retailers that are in their geographical areas. So have we? Nope, we're good. Okay. All right, well, first of all, thank you. We appreciate every one of you coming on and joining our webinar today, but most importantly, we appreciate Rochelle and Scott and Susan for taking the time to help us keep us updated. It's very important in this industry right now. It's trying times, as we know. We just want to be together, and as I said earlier, there's deep roots in this industry, and I call you Rochelle, and everybody calls you Shelley, but
Right.
you've been through quite a bit with us, and we do appreciate all that you do, and I will make sure that we share the documents that you shared with us, which will be the EIDL, it will be the application, and then I think there's a link that you shared with us to SBA. So we will definitely have that on our website. I will be able to share it. However, if anyone wants to contact either myself, which you have my email address, I think Marcy's is marcy@maho4health.org, and Renee's at Positively Natural is director at positivelynatural.org. We thank you all very, very much. Please be safe, be well. Wash your hands. That's the way you got to do it nowadays. We'll get back to the norm. It may be what we don't remember, but just make sure everyone is healthy. So thank you all very much.
Right, Deborah, thank you so much for
Thank you.
having us.
Thanks
Yep.
for hosting.
Thank you.
Bye.
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 Okay, end the meeting, end the meeting, end the meeting.